Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic, which is titled The Prudent Approach to Beating Fixed Income Investments. And this presentation is kind of a continuation of a wonderful essay that Angie Akers wrote a couple of weeks back in the Views section in the VectorVest program, where she talked about how we can use VectorVest to easily beat fixed income investments in this difficult market period that we're in. So each time I do a presentation, I like to list out the goals of the presentation, the specific reasons and goals of the information that I put together. The main goal always is to make you a better investor by using the VectorVest program and showing you how to become a better investor using our program. That's always the main goal. Tonight, my goal is to answer, again, this very critical question that Angie posed when she wrote, as investors during this difficult period, we must ask ourselves if it's possible to make more money in the stock market without accepting a heavier degree of risk as it relates to the fixed income investments. Okay, one point I want to make before I even begin to go back and look over Angie's essay is this. I'm not saying that allocating a portion of your assets to things like T-bills or the ETFs that track them, or higher yielding saving vehicles for you, any fixed income vehicle. I'm not saying that's wrong or ill-advised, especially if you're building and managing a retirement portfolio, closer to retirement, in retirement. Being safe with a portion of your assets, of course, is what you should do. Okay, but again, the question is about, is that the only way? Can we make money without taking on further risk? And one of the benchmarks that we're looking to accomplish here, I went back to Dr. DeLito's Stock Strategies and Common Sense. I went back to Chapter 5, and the first paragraph talks about, and I'll quote Dr. D, he said, beyond the need for current income, the minimum rate of return you should aim to achieve is equal to the sum of the CPI inflation rate plus the current yield on bonds. With inflation currently at 3.7% and bonds yielding 5.57%, your hurdle rate is now less than 10% per year. A couple of quick notes. I have an asterisk here because what I've done, as Angie did in her essay, I took the average yield of T-bills, T-notes, and the AAA corporate bonds per our market climate graph as of last Friday. It's a weekly number. Those will change this Friday on November 3rd. But for now, this is the average. In Dr. D's Chapter 5, he talks about AAA corporate bonds. I'm using what Angie wrote about, and that's the average of these bonds, just to be clear. So from here, what I want to do is jump into the program, and we'll take a look at Angie's essay, and we'll get an idea of what we're talking about. So again, easily beat fixed income investments. And Angie's essay, began talking about, the fear that a lot of investors are seeing now, right? We know that money goes where money grows. Okay, driven by emotions of fear and greed, investors will put their money where they believe it will grow the most. Okay, so when investors are fearful, they'll buy bonds or other fixed income vehicles. They do provide a low-risk alternative to buying stocks, but they also provide a lower return than buying stocks. And here's where Angie talked about the T-bills, T-notes, and the AAA corporate bonds. And I like the way she used the average of those depending on which you might allocate some of your assets for a safer haven here. But therein lies the question. During these difficult periods, can we outdo this? Because remember, as what Dr. D calls the hurdle rate of just under 10%, simply investing and putting your money in cash or simply investing in these fixed income investments are not going to be able to outdo that hurdle rate. So what Angie did was address the question by going to the trading system viewer. She put 3 specific pieces of criteria. She wanted an annualized rate of return that beat that 5.65, which was the average when she wrote this. She wanted it to be lower risk, so categorized it in the trading system viewer as a prudent or conservative type of investment plan. And that plan had to have a 1-year drawdown of less than 10%, keeping it prudent, keeping it safer and more risk averse. And then finally, a positive percent gain for the last 1 year. Okay, the trading system viewer is a very powerful tool. Angie lays out exactly what it can do for us and how we can sort some of the important information. So that's the basis for what we're going to illustrate here in this presentation. For now, I'm going to go to the main toolbar and go to the Graphs tab. And I just want to share a quick picture of the market climate graph to give those who may not be familiar with it an idea of what we're talking about. In the market climate graph, we're able to track things like the CPI, the CRB. So we're looking at inflation, we're looking at commodities. We've got T-bills, T-notes, and AAA corporate bonds. And as Angie wrote, of the week she wrote her essay, she took the average of these three, and that's what I did on the previous slide. Now that number will change through today's activity. The rates pulled back a little bit, the interest rates here on T-bills, notes, and bonds, I'm sure, but still pretty close to these numbers here. At the top, we have the earnings trend indicator. This is the S&P 500, the 50-day moving average of the S&P 500, the earnings. And we see that on a 0 to 2 scale, it has remained above 1 and has begun to tick up, closing last week at 1.06. And then we see that this is roughly a 2-year look back. We can see that inflation, commodities, T-bills, T-notes, all the interest rates are rising, right? It goes to Dr. DeLito's idea of how the market works, right? It's earnings, interest, and inflation that dictate the market, bull and bear market scenarios, etc. So currently, earnings are rising, but so too are interest rates and inflation, which does leave us in a bull market scenario based on Dr. D's truth chart. But I just wanted to share this chart and talk about where the numbers are coming from. So again, if we're looking at 3.7% inflation, we take the average of these numbers, it comes to just under 10%. And it goes back to the idea, yes, we're being risk averse, but if we're only putting our money here, those returns are not going to meet that hurdle number, again, that Dr. D talked about. By the way, if you haven't already, I strongly urge you to go into the training tab and download Dr. D's Stock Strategy and Common Sense, and you can read that entire chapter. It talks about earnings growth rates, among other things, and how important they are to our portfolios. So from here, I'm going to go back up to the main toolbar, and I'm going to choose the Viewers tab. And you can see it takes us right to our trading system viewer. You see here on the menu, I'm going to break this down a bit so we have a little bit more room. And when I come over, it is currently sorted by the highest annualized rate of return, right? These are the investment plans or the trading systems and the searches that are used and the risk management process behind them. Also shows us the market timing system that is used, and we categorize them as aggressive, prudent, or conservative. If I slide over, using the parameters or indicators that Angie wanted to use from her essay, she began by clicking on the 1-year drawdown. And she said she wanted drawdowns or searches or investment plans that had less than a 10% drawdown. She wanted the annualized rate of return to beat that average from the fixed income assets that we showed. And she wanted them to have at least a positive return over the last year. Okay, so that was the criteria she used. And we wanted to be sure, by the way, they were in the proper category as well. So what Angie did is she first typed in conservative here over in the search box, and it would bring up all of the searches or investment plans that would use the conservative category. Again, you see their market timing and the history of these that are here. So as we speak, there are 2 that meet the criteria of the drawdown. They also meet the annualized rate of return. However, the top one here is blue chip dividend payers, which this doesn't include the dividend payout, and it's a great search and a great investment plan. But under this Moneymakers 5015, which uses the profit locker, that's a profit locker stop of 50.15, had the 1-year growth, right? That was positive. So that met all of Angie's criteria for what she was looking for. We wanted to see if there were others, so we type in prudent. And now I'm looking at the prudent category. I come over to the drawdown and we can see currently there are 3 searches that meet the criteria of a 1-year drawdown of less than 10%. The annualized rate of returns over the life of these portfolios is fantastic. And then we see that 1-year gain on these are also all positive here. Okay, those 3 investment plans were top VST newbies, S&P 500 winners, again using profit locker 50.15, and the Midas Touch RT descending investment plan. So there's really a couple I'm going to focus on, and the main one is going to be the top one. I'm going to use top VST newbies. I'm going to talk about the Midas Touch RT descending, and I ran some back tests here just to give you an indication and dig a little deeper than just the numbers here, right? So we're looking at top VST newbies over the last year, up 11.3%. Annualized rate of return over the life of that is 21.5%, and it has the lowest drawdown. Okay. The market timing indicator used is the green light buyer RT kicker, and again, it's categorized as a prudent return. Let's go into the Unisearch tool. And I'm going to go into the Searches Prudent folder. And when I scroll down, it's going to have the top 20 newbies. That's the search that's used for this particular investment plan. It shows the parameters needed to make the list. Price actual of greater than $5. It's got to have some liquidity, over 250,000 shares. The VST, the Value Safety Timing Indicator, has to be above 1.4. And then we call it the top newbies because a week ago it was not in the top 20 by VST, but at the time of search it is, showing us stocks that are just getting in to the top of the VST list of over 9,000 stocks. Okay, so that's the actual search that we're using. If I hit run search, we'll see currently as I run this there are just 3 making it into the top 20 right now. But if you look at if I scroll over, relative value, safety, timing numbers are strong. Earnings growth rate is strong. All buy rated stocks, comfort index very strong. So these are the type of stocks that obviously look this way because they're moving to the top of the VST list. Again, out of 9,000 stocks, they're now in the top 20. So that's what we look at. Of course, we need to look at market trend. Just because they're in the top 20 of the top VST newbies doesn't mean we're going to go buy them. Remember, VectorVest at its core tells you what to buy, and when to sell. So that when to buy, we're going to stick to that green light buyer RT kicker combo timing system. The other search I ran some back tests on, and it's a search that we are looking to employ actually in our retirement coaching group, is the Midas Touch RT descending. And I may be introducing the top VST newbies for those who want to be a little more prudent or conservative. I think both of them are very prudent and very good retirement-minded investment plans, by the way. The next thing I'm going to go ahead and do is take us into the trading system details to share with you exactly what that information does. And this is the power of the trading system viewer, right? There's a long footprint here of what these searches and these investment plans have done for us. So if I scroll down a little bit, this particular portfolio was begun in January of 2019. You can see the returns on that overall. We give you the 1, 3 months, 6 month, etc. The returns and then the drawdowns as well. And again, over the last year, only 5.5%. The further you go out, the drawdowns will grow a little bit, but you'll see how powerful these smaller drawdowns are when I show you some back tests in just a moment. Okay, so that's the performance of top VST newbies. Okay. And then if I click on trading system rules, we can see exactly what the rules of the plan are. We're buying stocks from the top 20 newbies list. The stop criteria we're going to use is when the stock is no longer a buy rated stocks. We're buying 10 positions, automatically replacing them as long as the signal is still up, the rules are still up, and then the other basic parameters that we use. When the rules go down in the GLB RT kicker is when the VectorVest confirm call, market timing trend of the confirm call goes down. We go to cash. And then in the GLB RT kicker, we have neutral where we are now, and there is no action during the neutral sessions. Right? So we would not add any new stocks to a portfolio until the GLB RT kicker signal went to the upside. Okay, now that we have that, let me finally go ahead and take us into the backtester, and I just want to share some of the information. Again, backtesting, as we know, is a key component of effective trading system development. Okay, it's accomplished by reconstructing with historical data trades that would have occurred in the past using rules defined by this given strategy that we're showing. The results offer statistics and numbers so that we can gauge the effectiveness of this strategy. The underlying theory is that any strategy that worked well in the past is likely to work well in the future, and conversely, any strategy that performs poorly in the past is likely to perform poorly in the future. The biggest thing about backtesting, I believe, is that it builds a confidence in the investment plan that you're looking to put into place. And you must have a plan, a process, a technique, something that you're going to follow, knowing exactly what you're going to do before you get into that investment plan. So backtesting helps to build that confidence, understanding past performance is no guarantee of future results. We know that. And that even backtesting is not a perfect scientific method. However, when you backtest and continually show positive results, again, it builds that confidence moving forward. So that's backtesting. What I've done here is simply backtested top VST newbies over a period of time. I ran these simply on 1-year lookbacks. Now, for those who are more into backtesting and use different start dates and different things, of course you can do that to feel more comfortable and to build that confidence that I was talking about. But I went back to 2018 and I did it from November 1st. I ran these yesterday and finished them out today. And so we'll take a look at them. If I go back 5 years, right, almost to the day on top VST newbies using the process laid out in the investment plan, we're looking at an overall return of 114%. That's almost 23% annualized rate of return. We see our compounded rate of return at just about 16.5. And again, here's the key, right, is the drawdown. Remember, the whole purpose of this is, can we invest in the stock market without taking on much heavier risk? Now listen, there's always going to be some risk involved. But if we're going to make it over that hurdle number, 4.5 or 5% returns on our fixed investments is not going to beat that combination of inflation and interest rates. So great numbers there and very steady. I did the 1 year back from 11/1 of 2022. Again, positive returns, very small drawdown. And if I raise this up a bit, you'll see what that equity curve looks like. And that's a pretty, it's a pretty steady climb there. Keeping in mind that, we do go to cash each time that confirmed down call comes. I think that is a very prudent, conservative way to invest in your portfolio. I also ran backtests on the Midas Touch RT descending, which also made that list in Angie's essay and using the criteria she pointed out. Now here it's a little bit different, right? This shows over time much larger gains, right? This Midas Touch RT descending will get you much better returns. What you give up a little bit here is the max drawdown. Okay, the max drawdown. This year alone, the max drawdown met the criteria of less than 10%, and it has not returned as much. This one uses the DEW timing system, and that did whipsaw. We had a run in the middle of the year here where that whipsawed a bit. But what you do see are annualized rate of returns over time that really are much greater. Well, much greater. They're greater than what we see on the newbies here. But I will just make one personal note here. Anywhere between over a few years, 18, 19, low 20% return I don't want to categorize that as a real conservative return. I want you to understand that that's a pretty good return, regardless of what you categorize your investment profile as. There's a lot of hedge fund managers that would do a lot of things for annualized rate of returns over time at these numbers. Now, the Midas Touch RT Descending, as I noted, is going to be introduced to our retirement coaching group, and I think I'm also going to introduce the top 20 newbies as an alternative investment to some of the other investment plans that we have in place. I had said at the outset that the goals of this presentation was to answer the very critical question that Angie asked in her wonderful essay. Right? Is it possible to make more money in the stock market without accepting a heavier degree of risk than just fixed income investments? And so I'll go ahead and answer that. And the answer is yes. Yes, it is possible when we employ the power of VectorVest. So I'd like to thank you all for taking the time with me, and I look forward to seeing you next time.